The Fed and jobs are behind. Inflation is ahead. With the Federal Reserve and Fed Chair Powell throwing some nasty junk at the market on Wednesday with their policy statement addition saying that in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The dollar sold off on that new nugget of information directly from the Fed. However, that was followed by the chair's purposeful comment at his press conference when he said, "It is very premature, in my view, to think about or be talking about pausing our rate hikes. We have a ways to go." On Friday, Boston Fed President Collins muddied the water a bit when she said all options should be on the table at the next meeting, including 25 and 75 basis points, and that she supports a slower pace of hikes. Fed's Barkin added that now that real rates are positive, you could credibly say that we have our foot on the brake. Now, we know the Fed playbook. Get rates to restrictive territory, and the Fed is there. However, it took until September meeting, September 21st to be exact, to get rates above the neutral level of 2.5% as per the Fed's definition of the neutral rate. That means before September 21st, policy was expansionary or at the best neutral, despite runaway inflation that proved not to be transitory. It is now restricted for 45 days, about the same time that the UK Prime Minister Liz Truss was in office. Think about that. How many months was the rate below neutral? Or how about this? How many months was the rate at 0% to 0.25%? That highly expansionary policy was in place from March 2020 to March 2022, or 2 whole years. So I ask, is 45 days of restrictive policy the end of inflation? Is inflation dead? The jobs report on Friday puts that hope to bed. Jobs increased by a greater than expected 261,000. The prior month was revised to 315,000 from 263,000. Average hourly earnings were 0.4% versus 0.3% last month. Year on year, the average hourly earnings are up 4.7%. Now, I know employment is a lagging indicator, but so is inflation. It is too early to say inflation is dead. The U.S. stock market rallied nicely on Friday, but was still down on the week. My concern with the stock market is, man, it looks like the dot-com bubble into 2000 to me. From 1988 to 2000, the S&P index moved up around 580%. That culminated in the dot-com bubble bursting. After bursting, the price of the S&P fell around 50% in the next 25 months. The price of the index then recovered 105% of that decline to roughly the high of the bubble in 2000, and then fell 57% on the banking crisis over the next 17-month period. From that low, the S&P has moved up 625% over 154 months. But since January of this year, the 10-month return on the S&P saw a decline of 27.5% from the high to the low. The current decline at current levels is down 21.7%. Now, it's a sucky 10 months, but it was a sucky 25 months back in 2000 when that dot-com bubble burst and the price went down 50%. It was also a sucky 17 months that took the price of the S&P down 57.6%, starting in October 2007. The dot-com bubble and the financial crisis bubble were black swan events that were bubblicious in hindsight. Is the COVID area a bubble as well? A couple of pictures. Below is a chart of my friend's house value over the last few years. It moved up from around $700,000 in 2020 to $1.3 million in 2022. That is inflationary. Now, it's come off a little bit, like the stock market, but has it come off enough? My friend is still house rich. But if it were to come off more, and indications are it will, what would that do to his spending and to stock prices as a result? How about the Fed's balance sheet? The Fed's balance sheet went from $4 trillion to $9 trillion since 2020. What impact will the Fed balance sheet reduction have on the level of interest rates? Does that start to impact stocks more and more? The Wall Street Journal this weekend had an article about the sneaker bubble. The $300 million sneaker king comes undone. SMH. Or how about the SPAC bubble, or this one? Now you take away those bubbles and more, and wealth is destroyed. Sentiment changes, rallies become opportunities to sell U.S. stocks. The money is simply not sloshing around anymore. Admittedly, the pain has already been reached in some of these markets. I don't know what the price of an ape is anymore, but I got to think that they've come down quite a bit. Now add to those worries Russia, China, North Korea, and you start to think that is it wise for a company like Apple to have its production in China given the elevation of the us versus them from those countries? What does that do to inflation? Anecdotal stories of the movement of the chip production back to the U.S. is pushing up inflation for construction. All the resources are going to building those massive projects and sucking it away from other projects around the country. We have elections in the U.S. this week. Immigration is a key topic. One can argue that more immigration is needed to replace the aging baby boomers who are retiring. If the GOP wins the control of the House and the Senate, will their rhetoric toward immigration have solutions that stops all instead of just the illegal variety? There is that and more in the political arena that a shift in power may bring. And finally, there is the inflation data. This week, the CPI will be released with expectations of around 0.6–0.7% for the headline figure. The year-on-year is likely to dip to 8% from 8.2%, thanks to an even higher month-on-month increase a year ago. But 0.6%, 0.7% is not saying to me that inflation is dead. It says to me that inflation is still rising. The gain in your grocery bills and the purchase price of your new cars and the cost to repair your garage door or the heating unit in your house are still being pushed higher. The Fed chair was hawkish on inflation, and the jobs are still showing an inflationary foundation. So ahead is the CPI this week. The indications are it ain't going to help. Inflation is not dead. So what about the dollar? Well, it was mostly lower this week due to the sharp fall on Friday. It was only up versus the British pound and near unchanged versus the euro. Admittedly, that is a kind of inflation is dead that we saw in the movement of the US dollar this week. But understand, I can have all the views in the world, but I cannot move the market one bit. That is why I rely on the charts, because they tell me what the overall market is doing, what the bias is, and what the risk is. I can be bearish stocks or bullish the dollar as the COVID bubble bursts. But if the price of the US S&P index goes above the 100-day moving average and stays above, I'm not so bearish anymore about the stock market. So I will now look at some of the charts to see what levels are in play in the major currency pairs. I will look to define the bias and the risk and prepare you for the trading week ahead. Ladies and gentlemen, Greg Michalowski. Now that I've gone through the fundamentals by taking a look at the Federal Reserve interest rate decision and comments from Fed's Powell, looked at the jobs report from Friday and also gave a preview a little bit about the CPI coming up in the new trading week. Let's talk about the technicals and the risk-defining levels that are in play for the current week, because those will help to determine your bias for the market, whether it be more bullish or more bearish. So let's start off by taking a look at the euro versus US dollar. And looking at that currency pair last week, we saw a sharp move to the downside followed by a sharp move to the upside. This initial move to the upside here to the high for the week was off the FOMC rate decision. Initially came out bearish, remember, or more more dovish, I should say. And we saw the euro versus US dollar move higher, the dollar move lower. But then Fed Powell started to talk, and we started to see the reversal in the dollar. We saw the dollar get stronger, the market moved down to the downside. And then on Friday, we got the unemployment report. And again, the number came out stronger than expected. So we saw the dollar get stronger through here and then reverse all the way to the upside. So it was kind of one of those weeks where the news didn't really fit the price action. So we had the FOMC, which was initially more bearish and then turned more bullish. And then we saw the jobs report come out more stronger, so bullish for the dollar. And then it reversed itself, moved higher, so bearish for the dollar. So technically, where do we stand? If we take a look at this chart here, I want to focus on the 200-hour moving average. You see this green line in the chart here. And the price moved above that level on the spike to the upside, came back below it, and then reestablished support against that line. You can see it barely here, but the price did find support against that level before moving to the upside. That move to the upside took the price above this red line through here. And what does that line represent? At the 0.99515 level. And if you recall, this is one of my favorite levels. If I go back to the daily chart, and I admit I'm in love with this level. If you go back to this low back here in July, the low came in at 0.99515. That was the first time this year in a number of years that the price broke below the parity level, and the price moved down to the 0.99515 level. Admittedly, the price traded above and below the level through here, so it really didn't do much. But then in the month of September, we did start to find a lot of different support levels through here, right near that 99.51 level, until the market broke below that level, and that led to the move to our cycle low for the year and multi-decade low for the euro versus US dollar. The price has since moved back and forth since that time, including moves above the 51 level here and here. On the move above it here, the price found resistance against the 100-day moving average not once but twice before rotating back to the downside and getting back below the 51 level. And here on the daily chart, you can see that the price has moved above the 51 level, but not a lot of momentum above that level over the last, this is a daily chart, so the last week or so of trading. You can kind of see that on the 5-minute chart. Here's the 51 level, and through these days through here, we got above it here. We failed. We came up to it here and failed. We moved above it here on the FOMC day and failed. And we're closing above it this week and trading. So guess what? For me, we got to stay above the 99.51 level. If we're able to stay above that level and start to develop some value above that level, maybe get above the high price that we saw on Wednesday's trade, we'll be looking toward this level. This level is another swing area. See the different levels through here where the market found support and resistance against it. So get above that level, which happens to be right around the parity level, and we'll open up the door for, guess what, the 100-day moving average at 1.0051. That price held resistance, or that moving average held resistance through here. So that would be another key level on the top side. So 51, 99.75, parity, 99.51 on the top side for the euro versus US dollar. On the downside, if we go lower and we get below the 200-hour moving average, that should open up the door for further selling. We'll look at the 38.2 and then the 100-hour moving average down at 98.68, 98.48. Move below that level and we open the door for further downside here. Anything can happen. We've seen lots of ups and downs here in this currency pair. Buyers are trying to take more control above the 51 level, above the 200-hour moving average. But if those levels fail and we start to move back lower, watch the 200, watch the 38, watch the 100 on the downside. Those will be key levels in play for the euro versus US dollar. Let's take a look at the dollar versus yen, and what is significant in this chart is the number of times the market tested this trend line. 1, 2, 3, 4, 5, 6, 7, and then on Friday the market came up to that level or toward that level after the jobs report, found sellers against the level, pushed to the downside. The move to the downside fell below the 100 and 200-hour moving average. We were closing below that level. We also fell below this swing area here, this yellow area here, where we have a number of different highs through here, and then found some support against that level. Got a little messy here, and then reestablished resistance through here. Moved back above it right here and tried to stay above it through here. This is the FOMC day where the market spiked to the downside and then rotated back to the upside. And in trading on Friday, we fell below it once and twice. So guess what? We're going to need to stay below this level in order to keep the sellers more in control. That area comes between the 146.81 and 146.98. Let's call it 147. Stay below 147. The bias remains to the downside here, looking toward these levels. If we move above the 147 level and then start to get above the 100 and 200, of course, we're going to look toward the trend line right here, key trend line with a number of different levels along that line. That we're going to need to get above that level in order to get the bulls back in charge here for the dollar versus yen. Let's take a look at the sterling versus US dollar in the hourly chart. Where do we notice the price stalling out on Friday? Stalling out right here against the 100-hour moving average near the 50% retracement. The move down from this high to this low in the new trading week. This level is going to be our barometer. This area is going to be our barometer. If we're able to trade above the 50%, trade above the 100-hour moving average, bias is going to be more bullish. We'll be looking toward the 200-hour moving average on the top side. This swing area right here around the 114.95. Move above that level and we start to open up the door for further upside to the downside, upside to the underside of this swing area through here. So those are our targets for the sterling versus US dollar. Now we could easily find sellers against this level right here and start to move back toward the 38.2. On Friday's trade, the initial move to the upside did find resistance against the 38.2% retracement. So that's of significance. It increases the level's importance on the way back down. So if we're able to get below that 38.2, it should open the door for further selling. May ultimately go back down toward our double bottom here that we saw in the Asian session and then later on in the New York session after the jobs report. So that would be the favorite path for the path for the sterling versus US dollar, both on the top side and the bottom side. Let's take a look at the dollar versus Swiss next. And of significance in this currency pair is this green line in the chart. And if you go back in time, all the way back to here again, this is the 4-hour chart. So each of these areas between these dashed lines represents a week. And so in trading, not the current week that we just finished, but the week before, we did find support buyers against that 200-bar moving average. And we go all the way back to this week. In September, we found a number of different buyers against that level, and that helped to push the price ultimately to the upside here for the dollar versus Swiss. And so the corrective move off of this high came right down to the 200-bar moving average, and we found those support buyers. And in trading this week, where do we find our sellers? Well, it was against the high price through here. And where do we move back down to? Move right back down to the 200-bar moving average, just like we did here. Okay, so there's a symmetry, except the moving average is moving higher. It's an easier hurdle to get to and through. But nevertheless, that moving average will be our barometer for the new trading week. If we stay above it, it's more bullish. We look for the 100-bar moving average and look toward our swing areas through here and our hot double top up there. If we move below that 200-bar moving average, it opens up the door for the downside. First, get below the recent lows from last week, this double bottom right here, get below that level, and we'll start to look toward the low price from the prior week right through here. And if we get below that level, then we open up the door for a rotation down toward this swing area where we have a number of different swing highs and lows through here. So we'll be watching that level on the downside for the dollar versus Swiss. So needless to say, we're starting the week off near a key barometer for that currency pair. Get below it or stay above it is the way that the bias is going to shift for that currency pair. Let's take a look at the dollar versus Canada next. And what is significant in this currency pair is we were able to get out of this box toward the end of the week. This box had a number of different highs through here that caused a nice little ceiling. Admittedly, we went above it here, went above it here a few weeks ago, and then reestablished the level or the area as a ceiling here, including the high price from last week at 138.07, near the bottom of that range here that defines the ceiling in this red box. On the downside, we have the 38.2% retracement and all these other swing lows through here where the market found support against the level. And toward the end of the week, in the last 2 bars of the 4-hour chart, we were able to break below that level, below the 38.2 near the 135 level, up to 135.10. That's where these swing levels come in, is the risk level for in the new trading week. We're currently trading around the 134.75. So there's about 35 pips of buffer before the market tilts the bias back to the upside for this currency pair. When you have this area here and we make a break, we want to see the price stay below that level. So it's a key barometer, a key test for the sellers. We'll see if they can keep control, push the price down toward 134.07, then 50%, then the 100-day moving average, and this other swing area through here would be another key target level on the downside if the momentum to the downside continues for the dollar versus Canada. So be aware, key level right here near the 135 level. It will be our barometer for bulls and bears in the new trading week. The Aussie versus US dollar. It had one of those down and up trading weeks. Again, Wednesday, FOMC, Friday, job report. Sent the price down and up, nearly completed the lap in the down and up direction. In the move to the upside, we were able to get it back above the 200-hour moving average. That's the green line in this chart. In the new trading week, if we're able to move back below the green line on the downside, and then the 100, that's what would be needed in order to push this price further to the downside on the Aussie versus US dollar. Right now, the bias is more to the upside, with traders looking toward our high price that we saw on Wednesday's trade, and then we'd start to look toward the high price that we saw on last week's trading in there, 165.21, and then start to look toward this swing area through here between 165.31 and 165.46. You can see the number of different levels on the top side that would need to be make up of this swing area. So that's obviously going to be a key level going forward. So this yellow area right here is going to be a key level to get to and through in the new trading week if the Aussie versus US dollar is going higher. Finally, as far as the major currency pairs, we'll take a look at the New Zealand versus US dollar. And like the Aussie versus US dollar, we saw a sharp move higher on Wednesday through the FOMC, move back down on Thursday, and nearly a full retracement to the upside here for that currency pair. Fell just short of the 59.40 level in the new trading week. If we're able to move above that 40 level, that opens up the door for further upside for the New Zealand versus US dollar. On the downside, we'll be watching this area through here where we had swing high, swing high, swing high, break above it here, and rotate back to below it here, reestablish it here, break above it, fail, move higher on the FOMC, and in trading on Friday, we did move above that area right here near the 56.65, 58.65, 58.72. If we move below those levels, and then we're going to start to target the 100 and 200 hour moving averages. So there you have a look at some of the major currency pairs into the new trading week. I hope they set you up for what the bias is and also where some of the risks are for each of those currency pairs. Should be an interesting one with the elections on Tuesday. Although, we may not even have the results for a month. That's what they're saying. So we'll see how that all goes. And then we have the CPI data also next week, which is going to be the major release for the traders in the current week. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.